We look at the historical precedent. That's certainly interesting, those stats right there, especially that 2022 stat. But those other three bounces, they came under considerably lower rates, a very different rate environment. Are you expecting history to repeat itself this year?
Well, I may not expect history to repeat itself. What is it Mark Twain is attributed with saying? History may not repeat itself, but it often rhymes. And we're expecting a rhyme here in the sense, if you look back historically, back to the period that was the 1970s to about 1979, 1980, interest rates were much higher. Inflation was much higher. You had a period in which Paul Volcker was battling double-digit rates of inflation that were stickier, much stickier than what we've got today, because his predecessor, Arthur Burns, had failed to curb inflation over a 7 to 8 period prior to Volcker coming on. And right now, we are really at a regime in which we have seen the Federal Reserve very reflective of Ben Bernanke's style, highly communicative, very sensitive as to the effects that its mandate has to provide a good economy and a good labor market. Basically, what you have is a better situation. So we think the market's going to respond to that. Avoid the noise and listen to the signal.
Okay, I like that one right there. Avoid the noise, listen to the signal. I haven't heard that one before. So right now you're favoring cyclicals, even with this higher rate environment. Give us a sense, when we're talking cyclicals, that's a pretty broad term. What sectors in particular are you looking at? And what's your focus in cyclicals? Why is that the right play right now?
Well, we think that the cyclicals are really, our goal is beyond essentially right now the retrenchment that we're seeing in here. And what we're looking at are the near-term, intermediate trends that are very positive, as well as the long-term trends. And it looks like, to us, what we've owned for quite a while, and we continue to like, it's tech, it's industrials, it's consumer discretionary. We think you need to own some energy in here. And ultimately, financials, once things settle down, are probably going to do very well.
So you're saying some energy. Just yesterday, our Brian Sullivan's interviewed the CEO of Chevron. He's forecasting $100 a barrel oil. There was a big note from JP Morgan last week saying maybe even $150 a barrel oil. So you're saying some energy. Are you getting more bullish on energy? Would you increase your weighting on energy if these prices continue to rise as they've been forecasted to do?
In fact, we have. Right now, our weighting in energy is up by about 0.5% over what the weighting is currently in the S&P 500. And the way things are right now, we would expect that we will ratchet that up so long as we see opportunity for prices of oil to rise. Related to predictions of $100 levels in the 90s, $100 level probably wouldn't be unlikely. How long it would stick is another question. The reality is there's plenty of oil around the world. It's just that a lot of oil has been taken off the market essentially by reductions of production. Both by OPEC Plus and within the U.S.
Yeah, good point. We did see the market respond a bit to that Reuters report on Russia. One last thing I'd ask you before we go, government shutdown. How seriously are you taking it? What are you telling your clients about it?
Yeah, the government shutdown is something that is always worrisome, that politicians would revert to that. The one thing we think ultimately, when push comes to shove, we are entering a period where we're approaching a presidential election, a really important election. We think for either side, for elements of those parties that would like to see some kind of drama and a shutdown to gain some kind of press coverage or whatever, will back off, because we think it would be basically political career suicide. Voters, we don't think, and we're not political analysts, but we think that voters have gone through a lot. They've gone through the pandemic, the supply chain problems, volatility in the market, and interest rates.
Okay.
No, not another problem, and one that can be avoided by politicians really doing the old-fashioned way, negotiating and thinking ultimately of the good of the American people.